Right, let's get into the nitty-gritty of all this then. And if you look at this chart here, let me just give you an introduction to all the important parts of this chart. First of all, you see the bar chart. Okay, doesn't actually matter what time frame it is, and that's why I've left the time frame out. Doesn't actually matter what the security is. The principle is what we want to focus on. You see the bars here. They could be 1 minute bars. They could be one day charts, 1 day bars, and you see the price falling, and you see it rising, and so on and so forth. Then you see the downtrend. Okay, which I've marked there, which I've labeled 1. I've labeled that 1, and you can see it there. Found the downtrend. Next, you look at a breakout from that trend to the upside as a purchase point. I've labeled that 2. This is where the price has broken out. You can see it's broken out from the downward trend, because when you draw this down trend line, when you draw that down trend line, you see the price has moved up above it. That's point 2. And that's where, of course, you get the breakout. Next, you set a stop loss. The next slides will explain what I mean by stop loss, but let me explain to you for now. A stop loss you place at a point where the price should not go if you're right. Let me put that again. If this is a genuine breakout, the price should not fall below the downward trend line. Therefore, because the price should not fall below the downward trend line, then what you immediately know is that if it does, there's clearly some form of error in the trade analysis, and therefore that's where we place the stop loss. So you can see I've placed the stop loss just below the downward trend line. It's actually at number 3, which is this line. That's the stop loss, because the price shouldn't go there. If indeed the price should not go there, if indeed there is a genuine breakout, because it should just move upwards and not downwards. So that's our stop loss. It means that's the point at which we take our loss. It means we were wrong about our analysis. We set a profit target based on a recent reasonable price level. If it's a genuine breakout, we should have some momentum, and that should see the price go up to a recent resistance or a recent high. So I've marked that at 4, which seems a sensible level, because it's at that point that the price had tried to move upwards and then fell down. Well, it's a reasonable supposition that it will continue upwards if we are right about the breakout. And we'll go through many more examples of this. Don't worry if this is a lot of information in one go. So that's our target. Next, we've got to set our reward risk level. Again, something we'll go through in future examples, but just to give you the introduction, what that means is our risk is clearly the difference between entry to exit. It's clearly the difference between point 2 when we enter and point 3 where we might exit as a stop loss. That's our risk. That's how much we could lose. Our reward is, of course, the difference between point 4 and point 2 where we entered and where we expect to get to. So that's our reward. That's our risk. Our reward should always be greater than our risk. Otherwise, we don't place the trade. So that's how we work out reward and risk. In terms of correct trade size, something I will definitely talk about as we move forward. Okay, so let's look at some other examples. That's the deal setup. We enter the trade. Let's look at some other examples. Okay, let's look at this one. Okay, what we've done here at point A is we've circled an area marked A on the left-hand side of the chart, and this is considered to be a base, because the price has been trading within a range, and it's formed a bit of a base, as you can see. It's formed a base. It's gone boom, 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 boom. That's formed a base. This is where the market has been ranging between two prices for a period of time. The longer the basing occurs, the greater the breakout anticipated. You could have traded the breakout from the base before the actual gap breakout indicated by B. This is the breakout, point B, for the momentum trade to the short side. There is a gap between the close of the previous day and the opening price of the breakout move. The price gap slightly lower and continued lower for the rest of the day, closing on the low. This is an important indication the breakout is valid. When there's a gap and it closes near the low for the day, it suggests, wow, this is a real breakout. Same analysis as before. We need a stop loss. Well, it shouldn't go into box A if we're right, and we need to place a reward level, which would be a reasonable level given how much it's fallen even in one day. Then we work out, is our reward likely to be greater than our risk? Yes, and so forth. Now, this is on a one-day chart. It could easily, if you so wished, have been a trade you might have placed if you'd seen the pattern on a 1-minute chart or a 5-minute chart or a 15-minute chart. Let me continue, because you'll have lots of questions. Let me continue with more examples on this. So, point C. The same setup as in B happened again at this point, a base, then a break lower. At this point, point D, a long opportunity is presented after basing at region A, the circled area on the right-hand side. At point E, the long trade would have been stopped here as the follow-through did not materialize. You just didn't see the follow-through. By this, we mean the momentum was not shown to be sustainable. So although we broke out and saw that, but we really didn't follow through. Now, you may or may not have placed a stop loss, depending on what reward angle, what reward levels you are looking at. And if you're looking at a higher reward, you may not have stopped out. But you can see where you would enter from a breakout, what your reward projections are, and where your stop loss goes. That's a trade. That's all the information you essentially need. Again, let's look at some more. A is the shaded area, is the base, which we expect to break out to occur. B, there is a price breakout from area A, and you can see a gap between the close of the previous day and the opening price of the breakout move. This price is driven, the price is therefore driven up. Now, you don't need gaps necessarily. These are just extreme examples I've shown. When there's a lot of price pressure, you'll often find gaps, but you don't always need gaps. Note that if after the breakout the price goes back into the shaded area, then we would be stopped out. That's our stop loss. This would indicate a return to the resistance level of the basing area A, and as such the setup is invalidated. We would have placed our stop at this level when entering the trade. Okay, so several points to make. Each time the price makes a new high, we then move our stop up. This is, of course, a trailing stop. We'll come to stops later. Number 2, a rule of thumb is always to sell half your remaining open trade at any weakness of the momentum, example at 2 or 3 period low. You can carry the remainder of your trade over as long as possible. Just before point D, the price has made the lowest it's been over 3 periods. I expect 3 period low, and we would exit. Of course, the irony is it then rises. Well, that's fine, but we're going to be cautious. At 2 or 3 period low, we may well exit once we've got in. So I'm not just going to show you winning trades. You can see what would happen where you exit at a 2 or 3 period low, and then, of course, it continues high and you kick yourself. Well, that happens in trading, and that's fine. But it's better to be safe and have a 2 period or 3 period low as our stop loss, as our trailing stop rather, than not. What's a trailing stop? Well, a trailing stop is what you put in place after your initial stop. The initial stop, don't forget, was in the breakout area of A. I'll just go back to that to show you that was in this area. Of course, as the price rises, you're not going to just keep it there forever. You're going to move it forward and upwards. And I say a 2 or 3 period low is one such trailing stop, but we'll come to trailing stops and stops as we progress. So what about this? Here again, got a classic example, breakout. Again, I've shown a breakout with a gap. You entered short, you place a stop loss. Just you've got 2 options. You can either place it at the point shown there, or some people will place it all the way up here. It's really, it's really up to us. I won't say one's better than the other. There's rewards and risk associated with both. If you put it high, you've got a greater risk you're taking. Of course, if you take it lower, you could get stopped out a lot more easily. Very often with such a breakout, a valid breakout, you'll get a spike in volume. I don't tend to look at volume analysis, but that validates and strengthens the breakout to begin with. And that suggests it's going to move lower there. And you could see you might have set a target. Equally, if you haven't set a target, your trailing stop may well take you out in any event. So let's have a look at this one. A, this is a trend line from which we notice a breakout, as we've seen. B, the price of Intel gapped higher and closed near the high. I've shown Intel, could have shown Forex. doesn't really make a difference. The principle is all the same. This was just a really nice graphic one to show. Intel gapped higher and closed near the high on better than average volume. This point B is the day's low, and the stop we apply the next day. You don't necessarily have to be that precise, but point B is where you can put the stop at the low of point B. Yeah. Our first profit target for exiting half our position is the resistance line C. You can see why it was picked, because it was a recent high. We need to be aware that Intel may not actually break through the resistance because it has reached this point twice recently and turned around. So we've got to be, we've got to have reasons why that's our first take, half our profits. The price is in new territory at point D. It becomes harder to pick a reward target, but a trailing stop will help. A 2 or 3 period low gives us an idea that actually that's fine, even though we don't have a target ahead in mind. Now, beware of false breakouts. The price of the breakout candle must close near the high for long opportunities or near the low for short opportunities. This is the determining factor of the trade being taken. Okay, you can see false breakouts. The price rallied and closed very near the point A. So although the price had gapped lower, the trade opportunity was to go long at the end of the trading period. Observe that the momentum intraday seemed to suggest that there was more upside to come, most likely to fill the gap. So you notice how even though the price fell, we were going long and not short on this breakout. And why? Well, because after the price fell, it closed near its highs for the day, which suggests there was a lot of buying pressure. People think, oh, it's been overdone. And such gaps often close. In other words, the price often trade up to them as well. So you can see here that when you look at some of these characteristics of a breakout, you've got to really pay attention to, does the price at the end of that period close near the high or the low, which will tell us our direction. It'll also tell us where to place the stop loss. Our take profit levels will be, if we're going long, we may well have a take profit level so it closes the gap. If we're going short, our profit levels will either be the trailing stop, of course, as it would be on a long, or it'll be a recent resistance level. Now, with this trade, because the opportunity was long, once we entered, you can see that our stop loss would be if the price moved back to the low of that period. Okay, so that's breakouts. A lot of information there, a lot to go through and revise it again, but we've learned for that one, we've learned when to enter, when to place a stop loss, where to do a take profit, our reward risk ratio analysis. Now we're going to continue with more on breakouts and stop losses.